Okay, so now we're going to talk about some fraud-related audit procedures over cash. Okay, so the first one we are going to talk about is some extended bank reconciliation procedures. Okay, and these actually aren't too different from the bank reconciliation procedures we've been talking through all along. It's just basically a much more intense audit of the bank reconciliation. So normally we have the bank reconciliation, and what we would do is we would make sure we confirm the balance. We would make sure we tie this to the trial balance. And then for reconciling items, what we typically do is test all reconciling items over our scope. And scope is remember, is going to be your allocated TM for that account. So if scope for cash is something like half TE, we would say, I'm just going to examine all reconciling items greater than half TE. And to be clear, that would be in total. So if deposits in transit in total exceed half TE, then you would test deposits in transit. You'd basically be testing a sample of them. So with respect to extended bank reconciliation procedures, it just means you would be testing the bank reconciliation much more extensively. So you might want to test every item in the bank reconciliation. You might want to use a much lower scope, so the more items would get picked up in your test. You might want to make sure you're catching all those service charges. An example of why you would do these types of procedures and how they could catch fraud is described here. So it basically talks about how an employee could steal cash. So let's say you could steal $5,000, and then, of course, your cash balance would be $5,000 too low. So the way you could hide that is in the bank reconciliation. Could cover the shortage by including a fictitious deposit in transit, right? Because let's say I stole the $5,000 in cash, right? Then the $5,000 is still on the books, but I stole the actual physical cash. So the bank balance is going to be 5,000 low. Books is going to be 5,000 higher than the bank. So how do I make up this difference? I can add in an extra deposit in transit, right, of $5,000. Another thing I could do is leave off one of these outstanding checks. I could say it's only for 25 or 31, right? I can make an outstanding check smaller. So this is why doing extended bank reconciliation procedures where I'm testing a lot more of these reconciling items could help me catch these types of intentional errors or this type of fraud. Okay, a proof of cash is another type of procedure we might use to catch fraud. And this schedule shows a proof of cash, and basically what it shows is activity that's happening within the month, okay? Receipt and disbursement activity within the month. So you start off the schedule basically with the reconciliation banks to book for November. You end with the reconciliation bank to book for December. With a proof of cash, what I'm really testing is I'm making sure that the cash receipts and cash disbursements that the company has recorded during the period are correct. So the way I would test that is I would take all these individual cash receipts balances and cash disbursements balances, and I would essentially vouch all of these balances to supporting documentation such as bank statements or bank deposit slips, copies of canceled checks, etc., to make sure that these receipts and disbursements actually happen and they're at correct amounts. when they're happening on the days they said they were. Moving on. So kiting is a way of double counting cash. And the reason why you would want to double count cash typically is because, again, you're trying to cover up a cash shortage, right? Possibly because you stole some cash, right? Theft of cash, and we want to cover it up. And so we're going to do that by double counting cash. And the way we do this is we essentially violate cutoff. And I have a few steps here that explain how I do that, but essentially I do it by transferring money from one cash account to another cash account, and I own both of these cash accounts. And basically I deposit it in account number 2 before I record it leaving account number 1. So it's kind of in 2 places at once. It's deposited in account 2, but it hasn't left account 1 yet, so it's still in there as of 12/31. So I want to show you an example of this with journal entries because it's much easier to kind of visualize it with journal entries. So I've drawn out a couple of scenarios for you, and I want to talk through scenario 1 first, which scenario 1 is going to be not kiting. So scenario 1 is going to reflect what should happen when you're transferring cash between 2 accounts, both of which you own. Okay, so I have cash account A, I have cash account B, I own both of these 2 accounts, and I just want to transfer money between them. So this is what should happen. It is not, say, AKA not kiting, and the point of this transaction is I just want to move money from account A to account B. There's lots of legitimate reasons why a company would want to do this. For example, they might want to fund their payroll account, but they don't want a lot of money sitting in their payroll account all the time, right? So, okay, here's how it should normally look. I debit account B, which is the money where I'm moving the money to. I credit account A, right? It's very simple. And I'm moving $10,000. And the main important thing to note here is the debit and the credit happen at the same time on the books, right? So according to the books, the debit and credit both are happening on 12/31. Okay, this is essential for understanding kiting. So according to the bank, the money might take a little bit of time to move, right? Because we know with banks, deposits might take a few days, withdrawals might take a few days, right? Money does not move immediately, right? Transactions take a little time. They can take 3 to 4 days. So according to the bank, the deposit might happen on 12/31, but the withdrawal might happen January 3rd or 4th, right? But that's for bank purposes, right? And we're not worried about what's happening in terms of the bank's books. I'm worried about what's happening in terms of my books, the company's books. In terms of the company's books, my books should be balanced, right? And in order to do that, I need my debit and my credit to be happening on the same day. So this is what should happen in the perfect world if I'm not a fraudster. So now let's look at what I would do if I were trying to do kiting and I were trying to double count my cash. And this is just this little line is just a summary of the transaction. So obviously, as of 12/31, the net impact of this transaction is basically 0. And I have a total of 10K in cash, which will be sitting in account B. So scenario 2, which is what should not happen, is going to represent kiting. And the point of this transaction is not to move money from point A to point B. The point of this transaction is to double count my cash as of 12/31. So what I'm going to do here is I'm still going to debit cash account B as of 12/31, and I'm still going to go ahead and make that deposit, right? but I'm not going to credit cash account A just yet, right? I'm going to take advantage of the fact that things take a little while to move in the bank's time. And I'm going to take advantage of the fact that on the bank's books and on bank statements, things are going to take a little while to show up. So what I'm going to credit instead here is some other account. And I've just said fictitious sale, but it could be something else. It does not have to be a sale. I just said that because let's face it, I want to make my books look as nice as possible, so it's going to be a cash sale. So I have this fictitious sale that I'm crediting, and I have the 10 grand here and the 10 grand here, right? And these are both happening 12/31. Right, I need to credit something because otherwise books aren't going to balance. So as of 12/31, the balance sheet date, what do I have? The net impact on my cash account is going to be an additional 10K. So because of this, I will wind up with a total of 20K in cash because, right, my cash is now in account B, but it's also still sitting in account A, right? Because I haven't credited it yet. Now, in January 2nd, when that deposit actually clears the bank, now I will credit my cash account A, right? And I'll go ahead and get rid of that fictitious sale because I don't really want anyone to find it. So I'm doing this January 2nd. Again, that's good. Should be about when the transaction actually does clear the bank on the other side. So as of 1/2, my net impact in terms of what's happening with cash will be 0. I'll have 10K in cash sitting in account B. All right, so hopefully that makes sense to you in terms of how kiting is done. And again, the reason why people can get away with it is because things take a few days to clear the bank, right? If things were clearing the bank instantaneously, then you wouldn't be able to get away with kiting. But you can do it because we have things like, hey, deposits in transit take a while. These bank transfers aren't happening straight away. We have this federal clearinghouse system, which is why things take a few days to transfer. So that's why this happens. Okay, so theoretically, the best way to test for kiting is, as an auditor, is to create what's called a bank transfer schedule, which basically is going to show all these transfers that happen between the company's bank accounts that are happening around period end. So here is an example of a bank transfer schedule on this slide. And you can see it shows, okay, we have the dispersing bank account here, we have the receiving bank account here. We have the amounts of transactions, we have all the transfers listed, and you'll notice, okay, here are the days things are going out in bank time. This should probably say received by bank. The point here is we have these dates of when these transfers were received and dispersed by the bank, right? These dates, basically, for the purposes of doing this test, these columns are pretty much irrelevant. This is happening in bank time, right? This is cash basis accounting, right? Remember, we're interested in accrual basis accounting. So what you really want to look at in terms of testing the bank transfer schedule is the dates things are recorded on the client's books, right? And remember, what we want to see is the date of the debit and the date of the credit should be happening on the same day. So my receiving bank account, my debit, happens on 12/28 and transfer 1, and my disbursement happens on 12/28 also. So this looks good. And same with this one, both are happening 12/30. Same here, 12/31, 12/31. So transaction 4 is my trouble transaction here, which could represent kiting, right? Because I see the receipt, the debit is happening on 12/30, but the disbursement or credit is happening on January 2nd. And again, just to illustrate this, you see they're kind of taking advantage of the bank's slow clearing system, right? Because the bank showed it as received 12/31 and paid on 1/2. So this is how they were able to kind of get away with it because the bank statements supported with the dates they were saying. All right. But of course, we know this is kiting because we didn't look at the dates where things happened. According to the bank, we're looking at the dates things are recorded according to the books, which is what we should be doing. And we expect if all you're doing is moving money between two accounts, those journal entries should happen on the same day. So this is going to be our kiting transaction that needs to be fixed, right? When we say these happen on the same day, these are happening on the same day. So everything is good with transfer 5 and transfer 6.